Hi, good evening, everyone. Thank you for waiting. Let's go ahead and start the meeting. I think most of them have already joined. Welcome to each one of you who have joined us today for the webinar. We'll be looking at the technical analysis of the market, and also please feel free to keep dropping in your questions if you have any doubts in the middle, and I'll try and answer within the given time. If not, I will try and answer at the end of the session. So let's begin. Let's look at what technical analysis actually is. So basically, there are two types of analysis people do before investing or trading. They do the fundamental analysis or they do technical analysis. Now, fundamental analysis pretty much deals with everything to do with the particular company and the company's profitability and their future prospect. Like, for example, let's take Apple as an example. Now, Apple is a great company. You know, it's a good company because you have seen the past historical revenue that the company has made. At the same time, it's not just about the revenue; it's also about the products that they have. Is it going to be something that will still keep holding a larger market share in terms of when it comes to mobile phones or the laptops or the computer systems? And is Apple capable of coming up with more innovative technology in the future? If so, now this is fundamental analysis, and hence I would want to be invested in Apple because it has a good scope for the future. Now, that is what you do when you do a fundamental analysis of the stock. But let's say now you're looking at the technical analysis of it. Now, why do people use technical analysis? Now, we do know that Apple is a good company to buy and hold, or if you believe that it is a good company to buy and hold for the next couple of years, you would probably invest a small amount of money into Apple. But sometimes, let's say, if you're planning to invest a larger portion of your portfolio into Apple, for example, you would want to get the best price to enter. You would not want to enter right at the top if Apple is trading at all-time highs. Probably you're trying to look at entering when it gives you a good, decent dip to buy. Now, what happens with technical analysis is technical analysis gives you those indications to analyze where a market could be overbought, and at the same time, it can also help you identify what could be a good price to enter. So basically, technical analysis deals with everything to do with historical price movement, and based on the history of Apple's price movement, you make an analysis to identify a good entry opportunity. The same applies for trading as well. Investing or trading, technical analysis remains the same. The major difference between trading every day and investing for long term would be when it comes to fundamental analysis. Now, I know Apple is a good company to buy and hold in the long run, but maybe in the short term, it might not be a good time to buy for, let's say, if you're trying to capture only today's movement on Apple. It could be, it can go against you on a daily basis. Although the fundamentals are good, it might still go against you because you're looking at today's movement only. So that's where technical analysis pretty much helps you with both short-term trading as well as long-term investments. Moving forward, I want to just touch upon an indicator which is known as average true range. Now, ATR is something that you find on the platform that we provide. ATR basically, in short, if I have to put it, it tells you how many dollars can a particular instrument move in a given period of time. Like let's say, for example, if I'm looking at gold today, or if I'm looking at S&P 500, that is the top 500 companies index, and I want to know how many dollars can gold or S&P 500 move in a single day. Now, average true range does the mathematics and the calculation for you. I will show you in a couple of examples as well as on the live platform while I'm showing you live demo. So ATR helps you identify how many dollars it can move. Why am I showing ATR at the beginning is because, let's say, if you're a short-term investor or a long-term investor, you always want to know what kind of movement can I expect in a given instrument. Let's take Apple for example. If you're doing a short-term trade, if you're trying to take advantage of buying Apple today, and probably selling it off by today in the evening, or maybe you want to sell it off by the end of the week. You need to understand how many dollars can Apple move in either 1 day's time frame or in a week's time frame. So that is what ATR will help you do. ATR will help you identify how many dollars it can move, and using the ATR, you can plan your trade and your strategy for entering and exit. I'll show you a couple of examples on ATR as well as we move forward. Now, here's an example on SPX 500. For those of you who are not familiar at all with charts, do not worry about the candlesticks. The focus today is not on the candlesticks, but for those who do not understand what each of these candlesticks mean, it just represents the move that has happened. If you can look at the top left corner, I have chosen 1 month. So that means each candle represents 1 month's move. Wherever you see a red color candle, that means that particular month the price has actually dropped. Whereas wherever you see the green candles, you see that the price has gone up. So hence it's a green candle. Now we'll not get into how the candles are formed, but what this is showing me at the bottom over here, this is the ATR for a monthly time frame. So let's say if I want to buy S&P 500 today and hold on to it for the next 1 month, or even if we are not buying or selling, if you want to understand how many dollars can it move in a single month, we know that S&P 500 can move about $249 in a single month on an average. Now, this average changes over a period of time. Of late, the movement has become quite high. Whereas if you look at it from 2000 till 2015, the average movement on S&P 500 was just about $120. Now, there are two things that we understand. One is the average movement on S&P 500 has increased drastically in terms of monthly move. But at the same time, we also know that it can come back down to $120, which has been an average for a very long time, or it can remain at $240 moment going forward because of the current market conditions and all the quantitative easing that the US is doing to stimulate the economy. Let's look at a weekly candle. Now we are looking at a weekly chart. So on a weekly chart right now, S&P 500 moves about $124. Let's look at it on a smaller chart on a daily candlestick. Now you see on a daily candlestick, the S&P 500 moves only about $50. So if me as a short-term trader was trying to take advantage of today's move, I know the maximum it can, on an average, the maximum it can move is $50. Now, of course, there are days where it can move more than $50, like you see when it was dropping. Okay, there's a disclaimer that I would like to put out over here, which I forgot to mention in the beginning. The ATR tells us how many dollars a particular instrument can move, but it does not signify or it does not give us a signal in terms of which direction it can move. So we have another indicator for identifying direction or to identify potential direction, but ATR only gives you how many dollars it can move. So ATR, so for S&P 500, if you look at a daily chart, it suggests it moves about $51. That $51 can be a move upside or the move downside as well. Why do we use ATR? Let's say after all my analysis, I'm expecting S&P 500 to go up for the day. Now, because I know it moves about $51 in a given day, I cannot capture the entire $51. Obviously, you'll be able to capture maybe 10% of this $51 or 20%. So that's about $20 move from here. So, sorry, $10 move from here. So in this case, if I take a buy at this price, let's say for the day it has come up by $10. While I took this example, it was up by $10. So now I know that I can potentially make another $10 on the upside because the momentum is on the upside, and we know there is still $40 more upside move left in the instrument. So on those basis, I can take a trade or I can come up with an idea where a potential trade could be taken. Of course, not just based on ATR, we have to look at other indicators for the direction. But let's say all the indicators gives you a confirmation for the upside. You can take a buy and probably you can keep even a $20 take profit because we are trying to capture $50 I mean, out of $50, we are trying to capture $20. $10 has already been moved. I'm trying to capture another 20 out of this 50. Of course, sometimes people do get the entire 50, but then you will have to buy it exactly at the market open and close it when the market closes. That won't be practically possible for anyone. Now, looking at a 30-minute chart, for those of you who look at very short term, like you want to take advantage of market movement when the US market opens at 5:30. You want to enter at 5:30, probably enter by 6:30 or 7. So it's a very short term trade that you're looking at. So those are people who look at a chart of 30 minutes or even lesser. Now on a 30-minute chart, it shows me it can move only $4. So that means in the next 30 minutes, maximum I can expect it to move is $4. But if you look at the previous historical data, it can, on very big moves, you might see about $12 move. Again, you can see most of these big moves are coming when the market is dropping. So it is always advised to keep your stop losses if you're planning to take a buy in the market. Now, coming to the topic that we all had joined today to understand was Fibonacci. Now, Fibonacci is very interesting. I think some of you all would have already heard about Fibonacci before. And for those of you all who do not know what Fibonacci is, Fibonacci basically it's a sequence of numbers, starts with 0 and 1. If you add your first number with your second number, you get your third number. So if you can look at this in the example here, you add 0 and 1, you get 1, 1 plus 1, you get 2, 1 plus 2, 3, 2 plus 3, 5, 5 plus 8, 13, and it goes on to infinite. Now, why are these Fibonacci numbers important and how is it significant for us to do trading or investing? Let's look at how Fibonacci actually helps us. Before that, let's just look at this fun fact. It says Fibonacci sequence, also known as the golden ratio, appears a lot in nature. Patterns such as spirals of shells, curve of waves, sea heads, pine cones, branches of trees can all be described using the mathematical sequence. I'll give you a couple of examples on this. The fact that things as large as spirals of galaxies and as small as DNA molecules follow the golden ratio rule suggests that Fibonacci sequence is one of the most fundamental characteristics of the universe. So, what after a lot of studies that they've realized that these Fibonacci numbers pretty much appear everywhere in life, right? So I'll give you a couple of examples, and some do believe the Fibonacci numbers appear everywhere in life because there's a superior creator who created with a certain design. Hence, the numbers fall in place. So if everything falls in place throughout the universe, one is let's see if it is actually true. Second is I would still encourage you to do your own research on Fibonacci and see if these Fibonacci numbers appear everywhere in life. Like, for example, the most basic things I started doing after I learned about Fibonacci was look at, like it says, every creation has the Fibonacci number, or everything that we create as well has the Fibonacci number. If you do computer algorithm, or if you speak to a person who designs a computer algorithm, he will know about the Fibonacci and the golden ratio, and most likely they are following certain rules of numbers, which again falls under the Fibonacci sequence of numbers. Like one, two examples that I can give right out there is, let's say 5 is a Fibonacci number. Each of us have 5 fingers on a hand. There is a 2, which is a Fibonacci number. You have 2 ears. But let me go a little more in detail about Fibonacci. So basically, here's a geometrical representation on these Fibonacci. Basically, I'm sorry, it's little small, but you can see in the tiny box next to the 2, there are 1 and 1, which creates 2 squares. So you get 2. If you match up 2 plus 3 square, you get 5. And you see how these numbers also align these boxes within the same frames of the smaller numbers. Like 5 plus 8 gives you 13, 13 plus 21, 34, and this can go on to be infinite. Now, one thing that they've noticed is this also creates a spiral if you connect all the corners of each of these boxes. The other example, what we see over here is your tree. If you have any plants at home, I would suggest that you can probably look at the plant. You will always see If you can see on the right hand side, it says 1, 2, 3, 5, 8, 13, 21. So basically, the tree has evolved or grown with Fibonacci sequence. So the main trunk of the tree is one, and then from that branches out two major branches, and then out of each of these branches, it gets into more of these Fibonacci numbers. So best way you can do an experiment is, if you have a plant at home, you can probably look at how many stems it has on one single branch, or how many leaves does it have on a single branch, and it should align with one of these Fibonacci numbers. Excuse me. And now we see, here's the sunflower that is there. You cannot see the Fibonacci series inside this, but you can see the spirals inside this. So, which pretty much shows something similar to this geometrical representation. Moving forward, we'll see Fibonacci in our entire galaxy itself. So, our galaxy also has the Fibonacci series. Here's the geometrical representation on the galaxy. And you see, if the galaxy and the plants that we see, or the computer algorithms, the geometry, anything that we see has Fibonacci numbers. So if this was the case, probably these Fibonacci numbers also appear in the financial sector, or in a stock price movement, or anything else. So the study of Fibonacci appears everywhere, whether we like it or not. So it has been designed in such a way, whether we like it or not, Fibonacci numbers appear. So let's look at a couple of examples on how we can look at Fibonacci on the charts. So basically, the key Fibonacci ratio is 61.8, also referred to as the golden ratio. Now, I know that I did not show you guys how the percentage came about. Now, these are your numbers, and right now I've just shifted into percentage. Reason being, market moves in percentages. It does not move. Let's say there was a stock that was listed at $5. That does not mean the next target for that particular stock is $8 or $13 or $21. Probably, at least I have not seen it work that way. But what can happen is, there is a percentage of move that happens, and these percentage moves that happens within a given direction in the market always aligns most of the cases with a Fibonacci ratio. Now, I cannot use these numbers as percentages. I need to convert these numbers into percentages. So let's do one exercise. Sorry. If you'll have a mobile with you, if you're watching this on your laptop and you have a mobile next to you, let's take next 2-3 minutes just to understand how to create a percentage or get the ratio. Ratio is nothing but you divide your first number with the second number. Let's say, for example, let's divide 233 divided by 377 into 100. You should ideally land up to this golden ratio number 61.8. Okay, I'm sorry. Let me go back to the screen. I think now you can see the numbers. You can write your answers in the comment. Let's take about 2 minutes just to do this activity. Let's divide 233 divided by 377 into 100. I'll just wait for a couple of answers, then I'll move forward. I'm getting a couple of answers here. Okay. All right. Looks like most of you all are getting the right answer. Let's try something bigger. Let's try with a bigger number. Let's try with 75,000 25, which is right at the bottom. 75,025 divided by 121,393 into 100. So you should get 61.8 again. Perfect. Yeah. So now you see that if you can take any number from the series. Of course, the smaller one does not give you exactly 61.8 because the numbers are in very small fractions. But the higher the number it goes, you get 61.8 on the dot. And these numbers are infinite. You can just keep adding your first number with the second number, you get the third number. If you divide your first number with the second number, you get 61.8. Now let's come to the most exciting part. How are we going to use Fibonacci? If Fibonacci appears everywhere in life, and the assumption is it should appear even in our charts, and if that is the case, so that means we should be predicting every time it comes down to a Fibonacci number, it is a good signal to buy or sell. I will not give you my opinion on it. Let's put the Fibonacci on the charts and see how it is worked and how it works. And then I will also tell you what are the guidelines that you need to look at Fibonacci on the charts with. Let's move forward to the charts. Here's an example of Apple, right? So I will just give you one analogy that you can keep in mind while we are looking at the charts. Another example for the golden ratio. Now we saw the Fibonacci series, we have a couple of examples. We saw plants or trees have Fibonacci numbers in it. But how about the golden ratio, the 61.8? How about 61.8? How is 61.8 significant? If you all can do this at home whenever you're free, you should do it. If you, let's say, I measure my length of my hand. All right. So this is the length of my hand from my arm till my fingertip. Right. Let's assume that the length of my hand is 100 centimeter, for example's sake. Right. Now, if I take the length of my hand, which is 100 centimeter, and then if I measure from my finger till my elbow, okay, and take a percentage of my entire length, it pretty much comes up to 61.8. I'll tell you why I'm giving you this as an example. Let's just practically think of a human hand. The human hand has been designed in such a way, and your elbow acts as a very strong pivot point for us to lift things. If the one side of the arm was, let's say, if our arm was 50-50, like from our shoulder to, and the elbow was exactly in the middle, probably lifting things would not become practical. For those of you who do engineering and geometry, you would understand this. So for us to be capable of lifting heavy stuff, the elbow had to be 61.8% of the entire 100% length of your arm. Another example is also the height of your entire height from head till your toe. Your hip bones pretty much comes up to 61.8% of your entire height. I'm just giving you this as an example. Keep this in your mind when we look at the charts. Now, when I look at a chart, let's think about the length of the arm example I gave. So every time you look at a chart, we are identifying either one move upside or one move downside. We need to take a significant move. Now, let's say uh, from here, it has gone up all the way, like in terms of numbers, from $15, it's gone up all the way to $33. That's pretty much 100% move, right? So that is a good significant move. Now, the move does not have to be significant in terms of percentage, but at least visually, you should see there's a good momentum that has taken place before the momentum kind of broke down and started falling back down. So how you use Fibonacci is when you see a momentum that has picked up and the momentum has finished and it starts dropping, that is when you start using your Fibonacci to measure the height. Or in my example, my arm, you're going to measure the length of my arm. So you're going to measure this length of this rally. So you have Fibonacci in your draw tools. I'm going to show this on the live chart as well. In fact, let me just shift to the live chart. I think that would be more easier. Sorry. Yeah, I think all of you all can see my chart now. Yeah, perfect. So let me take Apple back again. Apple, the stock Apple, since a lot of people trade on Apple or look at Apple. I'm just going to do minor changes on my settings the way I look at it. Don't worry about it. Once you have your own consultant, he will take you through the platform and show you all the settings that is available. But for now, let's focus on Fibonacci itself, right? So we see a lot of rallies, then there's a drop, then you see another rally, then there's a drop, then you see another rally, then there's a drop. Now there's one more rally and the drop has not come yet. Now let's see what is so special about this drop. So let's implement our Fibonacci. Let's measure the length of this hand. I'm calling it hand because so that it can help you visualize things better. Because I give you an analogy on my hand. Let's look at this particular rally that happened. This happened. So I'm looking at a monthly chart. So it's a very long time frame. You can implement this even on a 30-minute chart, but let's not go into a 30-minute chart right now. So once you go to your draw tools at the bottom, you get Fibonacci by default on your system. You have to make it your favorite, or I think once you make it a star, it goes right at the beginning, so you should get it. But otherwise, there is a lot of Fibonacci's. You're going to be clicking on the first one, Fibonacci itself. So how do we measure Fibonacci? Exactly the same way you measure your hand, or in this case, let's say if I'm measuring my entire height, I'm going to measure from my toe to my head. So let's look at the measurement will be pretty much from the most bottom point or from wherever the rally had begun. That will be the feet of this entire body. And this will be the head because this is where the rally stopped. So click on Fibonacci, you click right at the bottom where the rally began, and you go all the way up till where the rally ended. Let me try and zoom this in for you all. Okay, the rally began on this particular candle here. Okay, so for those of you who have any doubts, you can just drop in a message. I hope you're clear on how to draw the Fibonacci because this is very crucial. If you have any doubts on drawing the Fibonacci, I can do it again. Please just drop in your comments. Yeah, I'm guessing most of you all are following with us. Okay, so I'll just do this one more time. Explain how to draw the Fibonacci because it's very important. Once we know how to draw the Fibonacci, then everything else becomes easy. How do you measure anything at all on the chart? First, we need to identify a significant rally. I would also consider this like, probably this also looked like the rally, this particular rally had ended and it looked like it was going to come down. But however, the trend continued after the third candle. So I'm measuring this rally from where it began to where it ended. So I go to draw tools, I click on Fibonacci, I click on where the rally began and drag it up all the way till where the rally stopped. Okay, now this is where the most interesting part or the exciting part comes in. Let me increase the font so that it will be easier for you all to see as well. Large fonts, perfect. Now there are a lot of other numbers on this Fibonacci which will not get into, so I'll remove that and let's just stick to a 61.8. Now we all understand that 61.8 was the golden ratio. Let's say if this entire move was 100% move. Now I want to know, like my arm. My arm was 100% long. Now I want to know where the elbow is coming. That will be at 61.8. So in this case, we see the market started dropping. It dropped over here, recovered a little bit, again continued dropping. And from this point, it started recovering, and then there was no other drop after this. And now, if I look at this drop, where does it lead me back to? It leads me back to 61.8. I know it looks magical, but it's not always magical. There are days where it breaks below 61.8. So it is not 100% sure shot that every time it comes to 61.8, it bounces back. I will show you a couple of examples where 61.8 did not matter, where the prices dropped even further. I have chosen Apple as an example. Reason being, Apple is pretty much there on everybody's portfolio. portfolio, at least everyone who has tech as a portfolio, the tech sector has their holdings in Apple. So thinking about Apple, every time Apple moves up or Apple starts dropping down, you can pretty much understand the thinking or the mind behind a fund manager. If a fund manager is kind of selling off Apple, that means they are trying to sell off the markets. So this is one way where you can think of when the market comes down. But when you see the price of Apple start going back up, you can also look at if Apple is being bought back, the entire market is now come to a good price where you can buy the other markets as well. Now, of course, now this is something that we have noticed over a period of time. There is no written proof that this is exactly what happens with a fund manager, but based on technical analysis, this is one way to look at it. But if we leave the fundamentals or what other people do and just stick to Fibonacci, let's look at what happened to the next rally. So we understand Apple rallied, it came back down, it took support on 61.8 and it has rallied back up. So let me just mark this. So this rally, this much we have already finished with. Now I'm just going to delete the Fibonacci. Now I'm going to look at the next rally. Where is your next rally? This is your next rally. You see that the market bounced up. It kind of ended rallying here and it has dropped. Now let's look at this particular rally here. I will draw Fibonacci from where the rally began to where the rally ended. Okay, I hope most of you are with me. I can, okay, yeah. So rally began here and rally ended here. Again, imagine my arm. Just think of this particular rally as my arm. And we want to know where's the pivot point. Where is the elbow where you will get the support back from. So you can see the market dropped here. It takes the support from this price and bounces back up again. Now, coming back to this 100% move that has happened here, you see it came back to 61.8 again and has taken support and has rallied back up. Now think about it. The previous time when it happened, it was in 2014 and the drop was in 2016. The rally began in 2016 and it ended in 2018. But the pattern pretty much looks to be the same. Now let's look at the next particular rally. So let's look at this rally. So we are done with identifying this particular entry. Now let's look at the next one. Let's measure bottom to top, right? So this was the pandemic drop last year, March 2020. You see the market dropping and then it recovered eventually. But then let's leave the fundamentals or what is happening in the market in terms of the pandemic or if there is US election. One thing, if you all have noticed, I have not included any fundamentals, any kind of news, why the rally happened or why the drop happened. It is purely technical. So when you do technical analysis, it's always best to stick to the strategies that you build your strategy, the technicals that you build your strategies on. If you look at the fundamentals and try and take a trade on a technical indicator, you'll be very confused. I'll tell you why. Let's look at last year's example when the market rallied. This was in 2019, market went up. Again, this is the arm that we are looking at. This is the 100% length of the arm. Now we are trying to identify the elbow once the market started dropping down. Now this market drop happened on a pandemic. The drop that we see over here was a pandemic drop, right? But even in a pandemic drop, you see it comes somewhere close to 61.8% and bounces back up. Now, let's say if you were trying to make a decision based on fundamentals and news last March, most of them, especially if you're very new to the market, you would be very scared to buy at this price. Reason being, every headline that you're reading, you see markets are crashing. All the headlines that you read will indicate that probably there's a bigger crash that is going to come. In fact, at that point of time, people were talking about a recession that was going to come. So in that case, what would you have done as an investor? You would have not bought this particular instrument, or you wouldn't have bought Apple at that point of time because of the fear of it dropping down further. But now let's look at it on a different angle. Let's say you did not listen to the news, you did not look at the fundamentals, I mean, of course, as a fundamental, we know Apple is a good company. Apart from that, you're not getting distracted with the daily news or daily ups and downs or a weekly up and down when you're looking at a long-term investment. And in a long-term investment, when this drop happened, if you looked at it on a technical perspective, in this case, we are looking at Fibonacci, you'd have definitely taken a buy because it's giving you a good percentage drop before a potential rally could happen. Again, like I mentioned to you earlier, it is not necessarily every time it comes to 61.8, it has to bounce back up. It can always come back down and it can go even further below. So there is certain risk management that you need to use no matter how many times Apple shows you 61.8% is a good buy, you still need to have some risk management in place if at any given point of time it starts going against you. So we'll come to the risk management part of it a bit later. Now, we understood even this was a very good entry point. So people who bought over here and who are still holding would be making good returns. In terms of how much returns, I will show you that as well. But let's just look at what is happening at this moment. The question is, what do we do at this current point in time? Do I buy Apple? Do I not buy Apple? Right now, we see the market kind of rallies up from here. Right, this is the new arm that has started to happen. We also see that the market looks like it can come back down, but it's not yet confirmed yet. We need to see a downtrend completely before I confirm this is the top. There could be cases the market might continue going up. We need to wait for the market to start giving these drops, like what you saw previously. You need to see at least these drops coming before you measure the Fibonacci. But in this case, let's just assume that this moment right now looks like it's consolidating. There are high chances that it could actually come back down. But a consolidation also could mean that it can break upside. So I would not take any decision for long-term investment on Apple at this point of time. Let's assume this eventually comes back down to 61.8. Now I know $97 is where I should be buying Apple and holding on to it again for the next couple of years if I'm looking at a long-term investment. So I hope I've been clear so far in terms of how to draw Fibonacci, and I hope you are able to also see how Fibonacci has worked in the past. If you all have any questions, can we look at? Can you just put it in the chat so that I can address it to you right now? So I have one question which says, let's look at current strategy based on Fibonacci. Historical is proving the point. Yeah, so I think that's what I did. So this is the current, I think what you meant was let's look at the current price to see how Fibonacci acts out, if I'm not wrong. So basically, this is the last rally that we've seen, and the price is still here. It's not yet, it's neither come down, neither has it gone higher than this. So at this point of time, this is the highest point. So I'll keep an eye on this. I'm not going to take any decision based on this. I will wait either if it goes up, then I will wait for wherever it goes till and then start dropping. But let's say in case where it comes down from here, I know 96 or 97 would be a good level to buy for Apple. Let's experiment. Apple is something that I should. Let's experiment on few other instruments, and I will not choose the instruments. I will give you the leisure to ask for any instrument that you would like to see. Is there any other instrument, any stock, or and let's try and look at stocks that has been there for some time, not a very brand new stock that has been just been listed because there's hardly any historical data. Someone has asked for Tesla. Tesla again is a very volatile stock and pretty much new in terms of compared to Apple, but then we'll definitely try out Tesla as well. Let's go. Let's come from a longer time frame to a shorter time frame. Perfect. So this is Tesla on a monthly time frame. So basically, it has not given me any opportunity on a monthly time frame. However, on a weekly time frame, probably there would be a couple of spots. Yes. So you see, there was a rally, then there was a drop. So you can take this rally. Let's just measure bottom to top. It did not take support exactly from 61.8 on the dot, but however, it came. This would have definitely been a good entry point either ways. Then you see the next rally that has happened. That was all the way from here to here. In this case, you do not see it come back down, so we avoid buying. Now we look at the final rally that has happened from this point to this point. Now, in this case, it has taken support from 61.8. So, hence Tesla has given a good entry point for people who are looking at little medium to long term holdings. However, like I told you, there could be cases where it can drop down, but in Tesla, that has not happened yet. And the data that we have on Tesla is also very minimal. Like 2014 till 2019, it's basically nothing has happened much on the stock. So, okay, we have another question. Someone's asked for platinum. I'm sorry, I can't show platinum because platinum is just a 3 month contract. However, we'll try and see if we can get a indication probably on a 30-minute chart. We'll do platinum. Bitcoin, very good question. We'll try it on Bitcoin also. Again, look at the instruments that I've showed you. I've showed you instruments that are stable, that has good fundamentals, and that has good logic behind it. Bitcoin is mostly emotional and sentiment based trades, but nevertheless, we can check out both Bitcoin and Platinum. Platinum Cash might not be available on the demo account, but if it is, however, we can still see it. Yes, gold is available. Uh, okay, there's also a question on, so Fib is always for long term investment, not for daily trade. No, Fibonacci is pretty much applicable even on a 1 minute chart if you want to use it. The reason I've been showing a monthly chart is because a monthly chart has less noise. I will just show you an example. Let's take Tesla itself. If I open a 30-minute chart on Tesla, right now, every rally that you see, every small ups and downs is like, let's say this particular rally from here to here is a rally. Then you have other rallies that happen from here to here. So this is just going to make it very, very confusing if you're looking at it on a shorter time frame. Hence, I need it on a longer time frame. But of course, you can use Fibonacci pretty much on any time frame. The fundamental, I mean, the base of how you apply Fibonacci remains the same. You need to identify, like, let's just look at the current market price. This is on a 30-minute chart. We see Fibonacci here. So this did not come till 61.8, or I think it did. Yeah, so this was a move that is happening on 30-minute chart on 24th of May. Okay, it jumped up, it came down, did not touch 61.8, but nevertheless, it was a good entry point at that point of time. Right now, it is going up from here and it is still going up. So I would not know till where it goes up. I need to wait for the price of Tesla to drop. Then I can put my up point and then see where to enter back on a 30-minute time frame. In terms of the other instruments, gold, cash, let's look at gold. Again, I'll go to monthly time frame just to keep the slate clean. You can implement this on a 1 minute time frame if you want to. The idea is the same. You need to identify a significant rally and you measure that particular rally, whether on a 5 minute chart or a monthly chart. The idea remains the same. Let's look at what has happened on gold. We see gold picked up momentum here. There was one sharp momentum here. Okay. Then there was another sharp momentum here and a very big one over here. So let's just go with the biggest one instead of doing all the tiny moments. So let's just take the bigger momentum. Okay, so you see gold gave this big momentum bigger than the previous ones and then it started dropping. So now let's say after a couple of months I see gold coming down. So now I know the top is done, and especially when I saw these couple of candles over here, okay, let's say I see these happening, This is when I'm going to draw my Fibonacci. When I see something like this happening, is when I'm going to draw my Fibonacci. Reason being, I want to buy back into gold. I want to know when to enter. So now what I'm going to do is I'm going to measure the bottom to top to see where is a good price to buy. In this case, 61.8 comes to 1,192. So 1,192 would have been a very good level to buy on gold. However, it went below that, breached that, and it has come back high above that. Now, let's say we were not available in this point. We pretty much came into the market somewhere here. So that is completely fine. We see a rally happen over here also. You see this upswing. Now, when I saw probably these candles dropping quite heavily, I will measure this upswing. Okay, and I see there's a good entry point over here. So this also came down till 61.8, and it keeps going. So you can keep measuring every rise. Let's look at this one. This one came much more below 61.8. So in this case, probably my stop loss would have triggered because I always have a stop loss whether 61.8 is working 100% of the time or not. Stop loss is a must, and this trade would have definitely hit stop loss. And current price from here, it has been just one-sided rally, right? This is all the way from August 2018 to August 2020, and now we see this drop coming in. So now this is where I am a little skeptical on gold, although a lot of people believe gold is going to go back to 2000. My ideal entry would be probably, even if I take this rally, this last big rally that happened here, one without any breaks in the between, I would still be comfortable to invest in gold when it comes back somewhere to 1600. Now I know 1600 looks like very far fetched, but if it does not, I will look at alternative investments for long term. Especially if I'm going to put a huge amount of money in gold, yes, I would wait for this price. If I'm putting a very small amount and I'm just trying to take advantage of a smaller move, then you can invest even today. But I'm looking at a monthly time frame, so I will think of all my trades on a longer time frame. Any other instruments? Okay. I have one other question. Is this live chart? Live chart. Yes, yes. So this is a demo account that I'm showing, but the prices are pretty much live. And on your live chart or the live platform that you're going to get for yourself has all of these instruments. It comes with the platform, and there is no additional requirement for accessing all of these instruments. There are a lot of instruments. If you go to technicals, you have a lot of technicals that can be used. Why we have chosen Fibonacci is because Fibonacci is very clear to understand. It does not complicate things, and it keeps it easy to identify trends and to identify entry opportunities. Now, let's say if I remove Fibonacci from the equation, I use Bollinger Bands. Now, Bollinger Bands, people do use Bollinger Bands, but then you see the idea on Bollinger Bands is every time it touches the upper band, you can take a sell, and every time it touches the middle band, you book your profit, and every time it touches the lower band, you buy, and every time it touches the middle band, you book your profit. Now, even the Bollinger Band pretty much kind of indicates on the downside it can come down till $1,400. But again, to keep in mind, we are looking at a monthly chart. Let's look at a 30-minute chart. Right, there's a 30-minute chart. Now these are for people who like to take advantage of daily trades, who want to understand how when to enter, when to exit. Let's say within one day. So a 30-minute chart would give you that indication. Now you know somewhere close to 1900 is a good buy for gold, and the minute it goes to 1905, you make $5 profit. That would be a good exit. If you want to maximize your profit, you can always wait till it goes to the upper band before you sell the product. So you're getting an opportunity to make about $10 over here on gold. I mean, this is an example on Bollinger Band. We are not covering Bollinger Band. I just wanted to show you how the other instruments work. But you have all of these indicators which will help you make decisions. Now, very important thing that we also need to understand is Fibonacci and how to use Fibonacci. Like for example, on Apple, we saw every time it came to 61.8, it went back up. But I also told you that that is not always the case because it can go further down, and if it goes down further, we need to have some sort of risk management in place. So this is very, very crucial when it comes to taking trades using Fibonacci. So I'm going to show you a couple of examples. Let's try and do a live trade if possible. Let's try SPX. Okay. Let me try on an instrument which gives you a good moment. Okay, I'm really sorry I did not include the ATR while I was showing you the live chart. Let me just show you ATR as well. I've chosen US 30 currently. US 30 is top 30 blue chip companies, top 30 blue chip companies of US, but put into one index. So all the companies put together, the value is roughly around $34,000. Now let's go to a 5-minute chart. Now this is what happens when you use a smaller time frame. There's a lot of noise you see that comes along with the smaller time frame, but it is still tradable, but it's just going to be a very tedious task. I'm going to implement ATR. So you get ATR in your technicals, and when you go to studies, there is ATR here. I'm just going to click on ATR. It opens up your ATR down below over here. Now, what does an ATR do? ATR basically shows how many dollars can this particular instrument move on a 5-minute time frame. Okay, in 5 minutes, this instrument can move $23. Let's change the time frame to 30 minutes. So in 30 minutes, this particular instrument, that is US 30, can move $48. Let's go to 4 hours. On a 4-hour chart, this particular instrument can move $118. And let's just do weekly for one last example. In a single week, this particular instrument can move $1,000. So now let's say you are a person who wants to take advantage of a short-term move. It is always advisable, although you're going to do on a short-term move, please go into a long-term time frame. Let's say you're someone who's trying to take advantage of the market movement on a 1-hour chart. Okay. Although you know that in 1 hour it can move $58, always look at the daily also to get an understanding. If worst case scenario, if it is going against you, if it's going in your favor, that's good. But if it starts going against you and you want to modify your stop loss, how many dollars can it go against you by? So it can go against you by $400. So that will help you make a decision. Now let's assume, let's try and see if there's a trading opportunity. Currently, I don't see any trading opportunity on US 30. Let me see if there is anything else. Let's look at Apple on a 30-minute chart. Okay, Apple kind of has given a drop. Let's try and see what Apple is saying. So Apple went up from pretty much this bottom to this height. You see, this is on 24th May where the rally happened. This is 25th May where the crash happened. And this is 25th itself around 12 o'clock, 1 hour before the market closes. Market has bounced back up. So yesterday, this would have been a very good trade to buy. Now let's just ride on this because I'm not getting a live trade to take because it's not giving me an opportunity at this current market price. Let's assume that I had taken this trade yesterday. So I'm going to take a trade at this price, 61.8. The blue line that you see is my entry price, that is 126.39. Okay. And now I need to keep a take profit. I need to keep a stop loss. Okay. Now there are 2-3 ways that you can keep take profit and stop loss. I will give you 2 ways of how you can keep a take profit and stop loss. One is by looking at the ATR. So what was the ATR for Apple? Now Apple shows me that, let's say I am going to invest, since I'm doing a short-term trade and I'm going to keep a stop loss, I'm going to invest $10,000 into Apple, right? So Apple, we are going to be entering at 126, and we're going to be keeping a stop loss as well. Let's keep a $1 stop loss. Exactly. Let me just change this. Okay, so there's a $1 stop loss. I'm entering at sorry, this should be 39. Yeah. So I'm entering at 126.39. My stop loss is going to be at 125.39. So my loss is going to be limited to $80 maximum. It would not go beyond that. How? Sorry, 79. How is it 79? Because you have bought 79 units of Apple, which is equivalent to $10,000. There's another way you can do it. Let's say you buy 100 units of Apple, okay, which is about $12,000. So in this case, what happens is when it goes against you by $100, you lose. Sorry, when it goes against you by $1, you lose $100. So your loss is always calculated on the number of units. Now, how did I come up with $1 move over here? It does not make sense if I just randomly put $1. I need to have some sort of calculation to know where I should be ideally placing the stop losses. One way to do it is there are other numbers which I did not touch upon, but you can always add it back on. So there is 78.6 and there is 88.6, and on the higher end you have 38.2 and 23.6. Okay, so I'm just putting these numbers back. Now let's not focus on how the numbers came in. It's very simple to understand how the numbers are calculated. If we divided the first number with the second number to get 61.8, you divide your first number with the third number, you get 38.2. Or you divide your first number with the fourth number, you get 23.6. Okay, so that's how all the other Fibonacci numbers are formed. Now, if I'm going to enter at 61.8, the next Fibonacci number or the most used Fibonacci ratio after 61.8 to keep stop losses at least is right below that, which is 78.6. Now, 78.6 is the square root of 61.8. I'll not get too much mathematical on you, but these are the numbers that is globally used, and everyone looks at these figures itself. So you can just keep your stop loss on 78.6. Now the question is, where do you keep your take profit? Now we understood our entry is on 61.8 and our stop loss is on 78.6. How do I determine my take profit? There are two ways to do take profit. You can put it back on 23.6 over here, or you just measure this drop where you entered. Okay. So now I'm measuring the drop. I'm not measuring bottom to top. I'm measuring top to bottom. And you see it comes to 61.8. Okay. So that is how you measure your stop loss and take profit. Now in this scenario, if you look at your risk reward, you're risking about $50 to make about, or $60 rather, to make about $120. So it is a 1:2 risk reward ratio. So every trade that you're going to be taking is going to be 1:2 minimum risk reward ratio every time you trade based on Fibonacci. Now there is another way people do it. They do not enter at 61.8. They try to take advantage of a much better price. That will be if the price come down to 88.6. So now they're not waiting for it to come down to 61.8 to enter. They wait for it to come to 88.6 and then enter. Reason being, now when you enter at 88.6, so this was your 100% move, and when you entered 88.6, your stop loss is going to be uh, away from your entire move. Away meaning right below the entire move that took place. So your stop loss is going to be here. Your take profit still remains on the higher end at 23.6. Now let's look at the risk reward ratio. Now you're risking just $50 to make about $200. So a lot of people who use Fibonacci try and get an entry at 88.6 to maximize their profit and to minimize the risk. Now, in this case, you can probably increase your exposure. Account value is $10,000. Maybe you can take a $20,000 exposure, provided that you keep your stop loss. If you do not have a stop loss and you're going to take a leverage trade, it is going to be very, very, very dangerous because one, it's leverage. Second is you put all your money in just one instrument. So please avoid doing that. If you're trying to put a $20,000, or even if you want to take a $30,000 exposure, for example, as long as you have your stop loss, this exposure is fine, because on a $30,000 exposure, your loss is still going to be limited to $100. If you're a person who do not mind risking $500, you can always increase it to even $60,000, provided that you have your stop loss. So stop loss is a must. Now I think on Fibonacci you would have learned how to enter. I just showed you how to use stop losses and take profit, so that you can take advantage of all the trades that you see on Fibonacci retracement, but with the stop loss and take profit. I'll give you another example where it would have failed for me. Let's look at this particular drop here. Let me close this. Okay, so I see this rise over here. This would have failed and also given me another opportunity. Okay, this was the rally that we saw, right? We see one big rally here. It dropped back down and it went back up, but this would have hit my stop loss. Let's say I keep a stop loss and take profit. Take profit is going to be on 23.6, and the stop loss is going to be at 78.6. I'm sorry, the numbers on these have disappeared. Let me just put that back. 23.6 and 78 and 88.6 default time. Yeah. So now I have my numbers. Let me zoom this in. Okay, so in this case, what happened was market rallied. It gave a drop. It came to 61.8. I took a buy, for example. But after I took a buy, I've also kept a stop loss here. Okay. And I've kept a take profit on the higher end. Now, in this case, let me go back to our initial investment of, let's say, $50,000, not more than that. Sorry. Yeah. Now you see, in this case, it came down to 78.6. Hit your stop loss of $100, and you were out of the trade. But what happened to the others who were looking at an 88.6 entry? They got another chance to enter. So let's say you took a trade at 61.8, kept a stop loss at 78.6. This hit your stop loss. You made a loss of $112, and then you re-enter at 88.6. Okay, and keep a stop loss right below the 100%. So now you're risking another $100 and expecting Apple to bounce back up. And in this case, it touched 88.6 after failing 61.8 and has bounced back up. In this, you made a return of $440. So that means you recovered your $100 loss, which happened on 61.8, plus you made a net profit of $300. And that is how people use Fibonacci to trade. They not just trade only on 61.8, they take a trade on 61.8, keep a stop loss on 78.6. Or if that fails, they again re-enter at 88.6 and keep a stop loss below 100%. Now, I know you would be asking, what Vivian, what would happen if it goes below 100%? Once it goes below 100% is where you need to stop trading on Apple for time being and let the entire drop happen and see till where it goes. And then eventually you can measure that on a longer time frame and see if that is a good level to enter. But let's say on a 30-minute time frame, the minute it goes below this is where you should stop trading Apple in terms of buying Apple at least. Yes, so I think I've covered pretty much most of the aspects in terms of entry, stop loss, and take profit. I have a comment here. It says, due to stop loss, 73% people lose money on this platform. Okay, so I agree with the person hitting stop losses multiple times, but the person who does lose at the end of it is not because of stop losses. It is mainly because there's no stop loss, or there is no proper logic in terms of where they've kept stop loss. I'll give you an example on this particular. Uh, let's say I take a trade. I buy maybe Apple. I keep a $500 stop loss and I keep a $1,000 take profit. Let's assume my stop loss triggers. I lost $500. I find another opportunity. Again, I will buy. This time I'll keep a stop loss again, but not for $500 because I took a bigger risk the last time. I'm going to keep a stop loss of $300 and keep a take profit of $600. Now let's assume this also hit my stop loss. So in this case, what happened was my stop loss was not consistent. Every trade should be same equal amount of stop loss. If I feel $500 is a lot for one trade, I need to break that $500 stop losses into 10 different trades. So that way, even if 5 trades hit my stop loss and 5 trades go in my favor, I still come out profitable. Now, what happens with the majority people who do end up losing money by keeping stop losses as well? Their stop loss is not consistent. Not every trade has a stop loss of $50, for example, or $500. One stop loss might have $50 stop loss, the other stop loss might be $100 stop loss. And to make it even more worse, not everybody's take profit is consistent. Now, there are people who risk $500 but book a profit of $200. So now what happens is you took a risk of $500. Instead of waiting to make $1,000 profit, they book a profit of $200 and they enter into another trade with a $500 stop loss, and that particular trade might go against them and hit a stop loss. So previously you made only $200, and on this trade you lost $500. So that way, to come to the profitable side, it becomes very, very difficult. In fact, it becomes impossible. The best way to be profitable if you're trading, one is your logic and entry for a trade has to be very, very well thought of before entering. Like in this case, if you're using Fibonacci, you enter only if it comes to 61.8. If it does not come to 61.8, there is no entry, so you can avoid that trade. Now when it comes to 61.8, you always keep a stop loss at 78.6, and you always keep a take profit back up at 23.6, and you do not modify in between because the strategy was built on Fibonacci, and hence you stick to the strategy based on Fibonacci while you are taking the trade. Again, most cases people do not stick to the take profits. Like for example, I'll give you an example. Let's look at a live example on Bitcoin. I'm sorry, earlier someone had asked me about Bitcoin. I did not show Bitcoin. Okay, I'll give you a very classic example of why people end up booking profit early. Like, let's say I'm drawing this on Fibonacci. Fibonacci came down to 61.8, broke below that, and it has come to 88.6. Now, let's assume somebody bought Bitcoin Cash at 567. Now, the target for this is $1,300. Majority, and your stop loss is here below the 100%. So let me just draw the lines because this does not have a limit price. This is your target. Okay, now someone who entered at this price currently is making a return of 29%. But the target is here. As per, if you are going with Fibonacci, your target is going to be on the higher end, on 23.6. Your target says it's going to make 137%. Majority end up booking profits the minute they see in the short run and miss out the profit on the long run. And because of fear of missing out this long run, a lot of people, what they do is they re-enter the market at the wrong level. They will, ideally my entry was here, my exit should be here, but entry happened here, someone exited here, and then they, to catch up with this, they start buying here, or they might end up buying a little higher, and then you see the market dropping back down, and out of fear they book the loss on that, and then market goes back up. So to avoid all this, if you stick to the logic that you're taking, and the logic should always have, if you're risking X amount, you should make a return of double the amount and no booking profit early. So in that cases, I don't see any reason why someone has to make a loss, as long as their logic, the logic as well as the indicators that they're using and they're following has been accurate and not modified while the trade is live. We have another question which says, when market is going up, it is difficult to use Fibonacci because all the trade will be high at that time. What do we do then? Do we do short selling? Yes, you can do short selling as well on Fibonacci. I did not cover short selling because a lot of people do not understand short selling. But since you had asked me a question, similar how you measured from bottom to top, you measure top to bottom for short selling. You measure this drop top to bottom. Now you see when it goes back to 61.8 on the higher end, this is where you can start selling. And this is 88.6 on the higher end to sell again, and your stop loss will be at 78.6 and above 100%. So the logic is still the same, but it is on the reverse side of the market. I've already overshot by 10 minutes for today. Thank you all so much for patiently listening to the technical analysis session. I hope you all enjoyed it. I hope it was easy to understand, and I hope I was clear and made it easy for you all to learn. We will be having more sessions like this in the future. If you have any comments, if you have any feedback that you want to leave for me, please leave it on the chats. And if there is any improvement required from my end, I would definitely use that for the next session. And if you all want to have one-on-one session, you can get in touch with any of our sales representative and probably fix a meeting with one of our market consultants, and they can sit with you for 1 or 2 sessions to have a one-on-one session to understand your requirement and your objectives for the account. Thank you again so much for waiting, and I'm sorry for overshooting 10 minutes. Hope you all have a nice day and look forward to more sessions with you all.